Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the week ended February 1st, 2017. I don't think anybody will be surprised to hear that we had outflows this week. About $13 billion exited the conventional fund business. We'll certainly talk about ETFs as we go on as well, but keeping a focus on there. Basically, we had some discouraging news. We saw that fourth quarter GDP numbers came in lower than expected, along with durable good orders in December came in lower than expected. But I think really what put people on a pause was some policy issues that surrounded President Trump's immigration ban over the weekend and how it was implemented. And I think another issue that kept investors really sitting on their hands was the idea that the Fed was going to come out and make statements. It turns out that they were pretty robust on the economy. They didn't raise interest rates, obviously, this time, but they certainly did not indicate that they were going to slow anything down either, and I think that was a positive sign. So I think we'll see some good numbers coming forward. But nonetheless, this week we did see big outflows. Let's take a look at the macro groups to see where those outflows occurred. Taking a look at equity funds first, we see that they lost about $1.5 billion. Taxable bond funds took in money about $0.8 billion. And muni bond funds for the fourth consecutive week actually took in money as well. $84 million this time. And the big bugaboo as far as outflows goes, money market funds, so about $12.4 billion in outflows. Well, let's see how this actually panned out in the individual macro groups themselves. Let's take a look at equity funds first and see what happened in that group. Basically, we had a decline of about 0.78% for the week. That's a pretty big chunk for a weekly decline for equity funds. Second week in three, we've actually seen negative returns, and it's the fifth consecutive week we've seen outflows, and this time to the tune of $1.5 billion. Now, breaking this out into domestic and non-domestic flows, we saw that non-domestic equity funds actually did a better job of taking in money, or actually losing money, handing back money. They only handed back about $0.5 billion, and they had a return that was just 0.52%. So they actually, from a performance perspective, did a little bit better than the domestic counterparts. Now, domestic equity funds saw about $1 billion in outflows. Fifth consecutive week they've seen outflows, and they had a negative return of 0.90%. Now, breaking this down even further, we take a look at large cap funds, and that's been the prior for many, many, many moons. We're talking 56 weeks or so that we've seen near or big outflows, actually the either lowest inflows or the biggest outflows out of that group. And we saw about $1.2 billion this week leave their coffers. And of course, the global equity funds, kind of that vote against the domestic equity side, saw about $700 million in outflows as well. Well, let's take a look at the ETF universe to see what happened there. We really had a night and day difference as far as flows goes. First week in three, we've seen positive flows into this group, $15.3 billion for this week. And at the top of the group, as it is when we usually have some big weeks, we saw Spider S&P 500 taking about $3.8 billion, PowerShares QQQ, Trust One taking about $1.5 billion, and at the bottom of the barrel, we saw Utility Select Sector Spider lose about $288 million, and Tech Select Sector Spider ETF lose about $209 million for the week. Well, let's take a look now at what happened in the fixed income universe, because we kind of saw some differences there. Our fifth consecutive week, we've seen positive flows, this time to the tune of about $800 million. Second consecutive week, though, that we've seen positive returns, 0.08% this week, so not a lot to write home about. But if we break this down and take a look at the groups that took in money, corporate investment grade debt funds took in about $1.5 billion. Ninth consecutive week they've taken in money, but as the story has been going, I've told you loan participation funds are actually a subset of the corporate investment grade universe in the old AMG product, and they saw about $692 million in net inflows. 12th consecutive week they've seen inflows. Also, we saw inflation protected securities taking in money as well. So certainly investors are betting on the fact that they believe that the Fed will be raising interest rates sometime soon. So that was certainly an indication. At the bottom of the group, though, we saw that international and global bond funds actually lost the biggest amount of money, losing about $274 million. So not that much as far as outflows goes, but big outflows nonetheless. If we take a look at ETF funds, now our ETFs on this side of the universe, we saw $2.1 billion in net new money come into the group. Second consecutive week, they've seen inflows. And at the top of the group, we saw the iShares iBox Investment Grade Corp taking about $788 million, while the Spider Barclays High Yield Bond Fund took in about $494 million. At the bottom of the group, we saw that the iShares Core U.S. Aggregate Bond Fund was the biggest loser, handing back about $291 million. Again, not that big of a story. Certainly it looks like investors are willing to go into the riskier types of fixed income funds with a preference really to be either in high yield or loan participation. Let's take a look at our muni bond fund group and see what happened there. For the fourth consecutive week, we saw inflows about $84 million this time, and it's the fifth week in six that they've had plus side return, 0.27% return. Not a bad return, really, when you look from week to week on a muni bond fund. When we dig down a little bit deeper, we see on national munis actually taking $100 million. That would indicate to us that single state munis certainly took it on the chin and lost a little bit of money. It's the fourth consecutive week that we've seen that the national munis actually have had net inflows. Well, that brings us to our last group, and that's money market funds. Money market funds lost for the fourth week in five, $12.4 billion this week. And how it broke out, taxable money market funds saw about $12.8 billion leave their coffers, and a further breakout, institutional investors took out about $11 billion, while the retail money market fund investors took out about $1.8 billion. And that leaves us with about a 423 positive net inflows into tax-exempt money market funds. Certainly we'll see stuff like that as the tax season comes along and people are thinking about trying to shelter some of those hard-won profits against a taxation. Of course, they're not earning that much in any of the money market fund arenas. Well, that's it for me this week, but we had some interesting news. We saw some ISM numbers come out today, but probably the most important piece that came out was the non-farm payroll report. Non-farm payroll came out about 227,000. It outpaced analyst expectations of 197,000. So I think we'll see some good flows, maybe some concern about inflation. We did see the unemployment rate go up to about 4.8%, but again, that's just because more people found it maybe more lucrative to come back into the market. Well, until next week, if you want to do a deeper dive actually before next week comes around, if you want to do a deeper dive, go in an area that I did not cover today, one of the classifications or one of the macro groups, certainly go to our site at www.lipperusfundflows.com, or you can join us next week where one of our analysts will talk about the fund flows of the week. Well, until next time, my name is Tom Roseen, thanking you and wishing you the best in your wealth planning and creation.